rather than having them confiscate your guns, rather than having them confiscate your gold and silver. What they have learned is that they can steal from you indirectly, and it's extremely popular. Quantitative easing, which is debasing the currency, is theft, and it's extremely popular. Debt and deficits are theft. They're an income transfer from young taxpayers to old beneficiaries like myself. They're publicly condoned theft. Artificially low interest rates is theft. It's a political war promulgated by the spenders who are numerous on the savers who are scarce. All of those are forms of government theft, and all of them are extremely popular. If the government went to steal your precious metals, that would be regarded by the population as a whole as overt theft, which it is. And that would be dangerous for the government to do, particularly with 400 million guns in circulation. But stealing from you by inflation, stealing from you by counterfeiting, stealing from you by debt and deficits, stealing from you by artificially low interest rates is not only more efficient, it's also popular. Why would they steal overtly and run a risk when they can steal covertly and be rewarded?
Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest that our viewers are always excited to see. This is Rick Rule, the CEO formerly of Sprott Asset Management, now of Rule Media. Rick, thank you for joining us here again on Liberty and Finance this Tuesday, April 27, 2021.
Always a pleasure, Dunnigan. And by the way, personal congratulations for the growth of your channel in terms of numbers and the maturity of the channel in terms of quality and content. You're doing a great job.
Oh, I really appreciate hearing that. Thank you. Thank you very much. We're trying really hard and have been for some time, and I'm glad that it's being appreciated. We do get a lot of positive feedback from viewers reaching out and saying that they're learning a lot, as am I. I get the easy job because I get to be here as everyman on the part of our 53,000 and growing subscriber base, asking the questions of people like yourself who bring us the insight that we desperately need because we're not getting it from mainstream sources, so we're seeking it here. So thank you.
Pleasure.
And thanks for your guidance along the way. I wanted to get with you particularly this week because I got an announcement about an upcoming webinar that you're taking a leadership role in, and it has the eye-catching and thought-provoking title, Robinhood, Reddit, and the Rise of the Retail Investor. And you've got an all-star panel you've pulled together to talk about that phenomenon. You and I had touched base on that briefly on our last interview together, and you talked about how retail investors who are organizing are actually creating or inventing or discovering a new fundamental. And so could you talk to us about what people can look forward to in this upcoming seminar, why it's important, particularly at this time?
Well, what's happening is fascinating, Dunnigan. To bring the listeners that are new to your station and haven't heard our prior interviews into the conversation, we discussed the fact that there's a very healthy phenomenon taking place, which is to say that the distribution of information is becoming democratized. Dunnigan, when you and I were younger, many years ago, information distribution was top-down. The government told us how to think. The academics told us how to think. Points of view were distributed by mainstream media, which is to say the LA Times, the New York Times, the Wall Street Journal, Time Warner, various criminal cliques. And investment information came from investment banks who were, let's just be charitable and say, compromised. What's happening now is that information distribution is democratized. The truth is that you need to know less. You just need to know how to know, because lots of information is available at Google or other places, Wikipedia. You don't have to have the same facility with the Reader's Guide to Periodical Information that you and I needed to have in our university years. In fact, Knowledge is information is available for the click of the mouse, but you do have to develop the talent to separate the noise from the music. You need to develop your own sense of paradigm. And there too, paradigm is distributed increasingly peer-to-peer rather than imposed on us from top down. And this is a fundamental shift in the way humankind stores knowledge, distributes knowledge, and discusses paradigm. My friend Doug Casey says it's a wonderful circumstance when the 1,000 points of light are not muzzle flashes from armies generated by the state, but rather people talking to each other and discussing things. And Reddit and your show, in fact, and what I hope to do in rural investment media are a small part in that. The idea that information and paradigm are distributed peer-to-peer rather than top-down, for all the noise, for all the discord, is a better thing. The feedback mechanism that one gets from a market for information is extremely valuable. Reddit is just one source of information and discussion, but one that's become increasingly important, both in terms of metals markets and metals equities markets. And so I think that a discussion involving important change agents, the Jim Rickards of the world, on this topic will be a very, very, very good thing. And we look forward to having that discussion on Thursday. This is a phenomenon that retail investors and traders need to wrap their heads around. I'm not trying to say that it's as important as things like tonnage and grade. I'm not trying to say either that is as important as management. But it goes to cost of capital. And in a capital-intensive business, cost of capital is very, very important. What's more important, I think, is that this phenomenon is brand new. The participation of retail investors used to be determined by the gatekeepers, the investment banks, and the gatekeepers are becoming absolutely irrelevant. Information, too, came from a very, very, very few periodicals, maybe all the way down in scale to the investment newsletters. But the truth is, increasingly, that services like yours are replacing the investment newsletters. And understanding the way that information, fact, fiction, and paradigm are all distributed in today's market is what is new in today's market. Understanding it gives investors, speculators, and traders a step up, an advantage over their competitors. And performance in the market, make no mistake, is competitive. You have to be better than the other person. You have to be quicker than the other person. And this is all about understanding a very new facet of what makes stocks, speculative stocks, narrative stocks, go up and down in price.
There are several things you made me think of as you were talking. When you talked about, we used to get top-down fed the information about what reality was. I had a flashback to 7 years old, black and white TV, Walter Cronkite signing off, and that's the way it is. And then later on, the tagline got changed to, and that's our report for now. And now it's, whatever channel you happen to be on, either cable or YouTube, etc. Another thing was the day that you mentioned research having changed. Instead of needing to know the Reader's Guide to Periodical Literature or the card catalog or whatever, we always would go to research librarians. The librarian was like the high priest of how to get the information. And the day that my image fell of that was when I called up the research librarian, and asked a very tough question, and the answer came back blindingly quick. And I said to the person, "How did you do that? How did you find the answer so quickly?" He said, "I just Googled it." That was a verb I hadn't heard at that point. But obviously things had changed. I was like Rip Van Winkle at the moment, and I had to catch up. But you're absolutely right that even when people quote unquote Google something or look it up, they're being given a particular presentation, a particular version that is filtered and curated for one purpose or another. But who is it that's doing the curating, and to what purposes are they being driven? The other thing you made me think of is investment advisors, retail investment advisors. We went to one of these seminars that prepares aging people for retirement, and had a nice steak dinner, by the way. But anyway, the investment advisor said he had walked away from a big brand name investment advisory firm because he couldn't stomach anymore what he was being told to sell by his superiors, because he knew some of the toxic mortgage-backed security, blah, 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 the things that were packaged up, and they were being told to go out and sell this to their retail public. And he knew that he was going to be leaving people exposed to very potential hurt by doing that. And so he walked away and founded his own firm. So anyway, things have been changing with increasing rapidity. So just things that squared with, from my experience with what you've been talking about. So what are people going to experience in this Robinhood, Reddit, and the rise of the retail investor seminar?
Well, hopefully, we are going to first explore the phenomenon so that people who have lives, people who think about their kids or their jobs or other things and haven't had a chance to fully understand the way that the market for information is changing, will get an overview. You can't really consider something until you have thought through it and you have digested the information from people who have thought through it, because there are many implications. And there are people who we will have in the program who have thought about this for literally hundreds of hours, already coming out of the information business. But then we intend to discuss how to use these sources of information to your own advantage. Each of us has our own skill sets. My own particular skill sets are credit-oriented, and I would say a pretty good ability to digest and utilize technical information. I may be the best consumer of geologists that I've ever met. I am, however, not very good at understanding the power of a narrative on a market or popular culture. I'm one of those rare persons that doesn't own a television set. And as you can see by the fact that I'm wearing the same shirt and tie as the last time that you interviewed me, I can't even dress myself without my wife's assistance. So what I can use distributed media for, what I can use Reddit for, what I can use programs like yours for, is understanding from other people who have different skill sets how it is that people make investment decisions. In other words, I can tap into popular culture by cruising on the coattails of people like yourself who have channels. So a lot of the discussion that we're going to have on Thursday is how to use the information that's available and how to use the paradigm that's available, which is different than the information, to improve your own investment performance. As an example, a very important part of tightening up the silver market recently came about from young people who regarded as a fundamental not so much the utility of silver, not so much the seasonality of demand for silver associated with the wedding season in India, not any factors with regards to silver that would have driven my own decision, its utilization in solar power or its utility as a germicide, but rather the fundamental that they discovered that I had been blissfully unaware of after 68 years on Earth was simply the short interest relative to the amount of silver available for good delivery. The fact is that there were and are structural imbalances in the silver market from a trading perspective, which is in fact in the near term just as much of a fundamental. It may be a derivative fundamental to the utility of silver. But the idea that after 68 years on Earth and 45 years involved in the silver market, that I had missed something as important as the volume of float relative to the obligations is interesting to me. Certainly, I understood from prior experiences in the silver, going all the way back to the attempt by the Hunts to corner the silver market, that there were imbalances in terms of the calls on silver, which is to say that silver had been hypothecated, that the futures markets often traded 250 times the silver available for good delivery in a day. I understood that. What I hadn't understood was the ability for crowd mobilization to take good delivery to change fundamentally the way that silver traded. As you and I talked 6 weeks ago, at the beginning of the exercise, what I saw was a situation where the silver market itself was out of balance, which is to say there was a sudden increase in demand for silver, and it was retail demand, and the retail demand couldn't be satisfied because there was a shortage of retail products in the silver market that itself was partly due to the fact that COVID had shut down the refineries, which reduce wholesale product to retail product and distribute it. What I didn't see was that a whole army of $300 or $400 speculators who were interested in the structure of the market more than they were interested in the market itself had the ability to change the parameters under which the risk managers at the biggest banks in the world look at the silver business. And this is the world that we're coming to. We're coming to a world which is wonderful from my point of view, where a very old dog named Rick Rule gets to learn a whole bunch of new tricks from 20-somethings and 30-somethings who might have less overall experience, but have more current experience, which I think is just a wonderful thing. I pick on silver simply because it's topical, simply because your viewers will understand the message about distributed information and distributed paradigm better if they think of it in the terms of that context. The other thing that I hope to talk about, Duncan, is that information and fact or factoids, which are different things, have become ubiquitous. We don't have to go to the library. In fact, this stuff comes at us every day in every way. And if you search for a fact on Google, what you will find is 5 or 6 facts, often contradictory, which is usually to say you'll find more factoid than fact. And what all of us need to learn to do over the next 5 years or 10 years is sort through various sites, guides, gurus, people, to help put ourselves in the frame of mind, acquire the tools, acquire the processes by which we can take this plethora of information, some good, some bad, and come to conclusions. My suspicion is that where all of this is going is that information is going to become less valuable because it's become commoditized. And branded conclusions will become more interesting. That is, people will search the web, people will search platforms such as yours, people will search gurus or whatever it is that I am, and learn that their own mindset requires access to branded conclusions, people who have sorted the information for them and can honestly make a case as to what information is important and what conclusions can reasonably be drawn from it. And I think it's going to be very, very messy. But I also think it's going to be hugely, hugely, hugely helpful. I remember giving courses on being a contrarian investor back in the days when the most popular business magazine in the world was Business Week. And Business Week had to convey such an aura of authority and responsibility that they had to put on their cover themes that were so time-worn that they were, first of all, wrong, but absolutely trustworthy. What Business Week had to do was deliver up pablum. They had to deliver up information that was so dated as to be useless, to convey authority and legitimacy on the banks that were selling certificates of deposit and the mutual fund groups that were selling mutual funds. And so they came up with such brilliant covers as the death of equities at the bottom of the equities market in 1981. The end of mining, I believe it was 1986. The Economist magazine comes to mind some years ago when they said, "Is oil going to zero?" It's important that one understands that the need for an accepted hypothesis among the very large purveyors of information is so critical that they are almost doomed to have covers like the death of equity at the bottom of the equities markets. And you need to defend yourself against that by having access to lots and lots and lots of branded conclusions. People who can organize facts in ways that you can assimilate and you can use. Sorry for that long-winded response, but I think it's an important topic.
Just made me visually remember the common wisdom that became grassroots at the time, which was whenever a CEO appears on the cover of Business Week, you should go short that company because it's become so obvious to everybody that they finally had to put them on the cover, and then that means that everybody else already knows. Oh, that's hilarious. And so telling. Now, when you talk about branded conclusions, it almost sounds, and I don't think it's what you mean, but so clarify the difference. It's not that we've come around now full circle back to the centralized top-down sources of information, but that there is an amount of legwork that people simply aren't going to be able to do on their own, that they aren't going to be able to slug through the hard grind of going through all the facts and factoids and filtering all that out. So they are going to have to find out people who have a track record that proves that they're trustworthy.
Absolutely right. Most of your listeners, as an example, won't have the technical background, if they're exploration speculators, to understand necessarily the significance or insignificance of a drill hole in a headline. What they will have the ability to do is sort through the various web sources until they come to somebody like Brent Cook and Joe Mazumdar, who do have that ability. Then, unfortunately, the story doesn't end there. After the exploration hole is put in place, what is the next question? What might a yes answer be worth? Where might the money come from? And there might be another source of information that is useful there. What the new distributed media or distributed knowledge allows successful speculators to do is construct an information metric or matrix, better, where you decide from your own point of view how you construct a good portfolio, and you understand the constituent decisions that go into making an investment, and you learn where to extract information from people who have done on your behalf the work that's necessary to make a correct investment decision. This has never existed before. At least it's never existed before in an honest fashion. In investment research, let's just say that too often the researchers were cheerleaders for investment banks, which is to say that investment research often told you more importantly who the investment bank was incented to sell, rather than which investments were competitive against other investments. And that's just an example. The world that we have in front of us now, Dunnigan, allows us, first of all, to learn how to learn, and learn how to learn very, very, very quickly. And then it allows us to select the sources of information, and more importantly, the sources of paradigm that we use to organize and systematize all of the information that's available to us. This, from my point of view, has never been available as easily in the history of mankind.
Something that just leapt out to me of what you just said, I think I'd like to suggest an amendment of, and that's we're given more information, more data, more opinions, more conclusions of analyses, more statistics than ever before. Gotcha. We completely agreed with that. When you talk about how to learn, I can't escape my concern about our loss of how to reason, how to understand, rather than just how to attach ourselves to a narrative or attach ourselves to a conclusion emotionally or otherwise because of some catchy way that it's expressed. So I'm gravely concerned about as our information technology has increased, I'm concerned that our reasoning ability and ability to think and to really make discriminating differentiations and delineations between fact and fiction is weakening.
Two comments to that. First of all, what you say in the near term is absolutely true. People are taking factoid as fact. People are paying attention, reacting to headlines. When I look, as an example, on YouTube, and I see some videos that I think are absolute pablum, but have good headlines, and they get 200,000 views, and I see other interviews that are absolutely brilliant and get 250 views, I think, oh, how sad. But that's the way markets work. In the near term, markets are very, very, very messy. And over time, all investors, be they old mossbacks like Rick Rule, or young $300 Reddit users, learn from their mistakes. At least the best of them do. What's important now is that the platforms exist that you can learn from your mistakes. And it isn't a one-size-fits-all world. There are going to be Reddit users, as an example, who become narrative traders, who become trend followers, who are less interested in the utility than they are the momentum and the structure of the market. Those people would be well advised not to follow Rick Rule, simply because I don't have skills in that regard. My own skill sets are much more credit focused, and that's fine. The truth is that there are many ways to make a living or increase your wealth in trading. What's important is that you develop your own techniques and you develop your own set of investment markers. You develop your own sources of paradigm so that you have a way to organize and systematize the incredible flow of information which is available in a way that makes sense for you. And this smorgasbord of paradigm and information has never been available before. Yes, you have to do the work to organize your mind, to systematize it. Absolutely. That's your job, not Dunnigan Kaiser's job, not Rick Rule's job. It's the viewer's job. But the truth is, it's available right now, today.
It's still, I believe, a tall order for most people. I think in this rush of this information fire hose that we're all, I guess, forced to drink from, I think that a lot of people have pretty much thrown in the towel. They can't even go through their inbox, let alone keep up with this. So they're just having to sort of back into a default position, which I think is not going to be healthy long term. And that's just taking those factoids or the headlines and running with them. In many cases, now you're saying, well, if that's the majority, then those are the people who will be in the unfortunate majority, because those who actually do take a bit more time, who develop the skills to take responsibility for discerning more carefully, are going to benefit. And I think you'd be right. So, yeah, you're right.
Well, nothing changes there, Dunnigan. The fact that the tools are available is wonderful. The fact that many people won't use them is unfortunate. That fact, in fact, inures to the benefit of those who do use the tools. Performance, like effort, is not ubiquitously distributed through society. And while it's unfortunate that not everybody will use the tools that are delivered to them, that's inevitable too. You owe it to yourself to be one of the people who benefits from the way the world is. Yes, it's unfortunate that there will be a lot of people, in fact, the majority, who don't, for whatever reason, use the tools and the information that's available to them. But there's no particular reason why foolishness and naivety should be visited on you.
Makes sense. And if we could, so I'm going to hit one more time if we could, and I'll ask you again at the end tell people how they can get connected for this event that's going to be this Thursday, April 29th, Robinhood, Reddit, and the rise of the retail investor?
To be honest with you, I'm so busy that I don't know. You'll have to post a link, which I will send to you.
Very good. We'll keep that in the description of the video, so people look for that. We'll make sure we have that for you so you can take advantage of that.
Yeah, there's a distribution of talent, and Albert Liu is hugely talented in that regard. Rick Rule is somewhat less talented. So.
Fair enough. Okay, so we've got some specific questions for you, our trusted mentor on many of these natural resource topics that our viewers have submitted, as they always do. And if we could hit a few of those before we let you go.
Great.
The first one comes to a question that we're all affected by and many are very concerned with, and that's the U.S. dollar. PV says, why does Rick Rule still believe in the U.S. dollar as a currency? How does he justify any value left in the dollar whatsoever?
That's a long question. My friend Doug Casey describes the U.S. dollar as the prettiest mare at the slaughterhouse. And while I believe that's a bit extreme, it talks to the fact that most of the world believes in and longs for fiat currency. The U.S. dollar is in fact a factoid rather than a fact. It's a credit instrument, but it's a medium of exchange that enjoys widespread support. There is still more trust in the U.S. dollar than any other medium of exchange, including Bitcoin and precious metals. And the U.S. dollar is also the underpinning of the deepest and most liquid savings market in the world, which is to say U.S. Treasury securities. I don't personally store my wealth in U.S. Treasury securities, but I don't matter. Worldwide savings and investment assets in the hands of individuals and institutions total $450 trillion. And sadly, my net worth stacked up against $450 trillion is less significant than a pimple on the back of a blue whale. I'm absolutely irrelevant. I remember once asking the head of let's call it a sovereign wealth fund from a very prominent Asian nation that had about $1 trillion in U.S. treasuries, how they felt about an instrument that I think over time would reduce their purchasing power. I described it, in fact, the U.S. Treasury, in fact, as a lie, given our income relative to our liabilities. And I remember my Asian counterparty looking at me and smiling and saying, "What you say is true, Rick, but yours is a deeper and more liquid lie relative to the other lies that we're being told."
Oh, my.
I said, "Do you trust us?" And he said, "No, but we trust you much more than we trust each other," which is to say that this country trusted the United States more than they trusted China. They trusted the United States more than they trusted Japan. They trusted the United States more than they trusted the European Union. Again, quoting Doug Casey, "The dollar is an IOU nothing. The euro is a who owes you nothing." And I think that goes to the relative strength of the dollar. I think that the dollar is extremely acceptable. It's broadly utilized. I think it's very, very, very dangerous to hold long term. And I think it's fatal not to hold in the short term. Dollar liquidity will, first of all, rob you of your purchasing power over the 5 to 7 year time frame. But dollar liquidity will give you the ability to act should there be a liquidity squeeze. So you need to regard the gradual diminution of purchasing power in U.S. dollar denominated savings assets as an option premium on the money that you might be able to make should we face a liquidity squeeze, similar to the liquidity squeeze that we faced in 2008.
Now, you've often talked to us about the ebbs and flows of natural resource opportunities. We have a question here about copper from Momo Chacha, who says, "Is it too late to enter a commodity space such as copper? Should we wait for the next market crash to pull in? If so, Do you expect one to come soon?
I'm flattered that I was asked the question, given how wrong I've been on copper. I had expected and said on your own show a year ago that I was concerned about the copper market because I was concerned about the broad economy. For the newcomers, copper is regarded as Dr. Copper because of its seeming ability through price action to describe the type of economic circumstance that we will face in the immediate future. My own particular belief was that the economy on a global basis was likely to be weak because of restrictions on trade and also because of a economic recovery, 2009 to 19, engendered, I would suspect, more by artificially low interest rates and artificial liquidity than by increases in productivity. I anticipated, too, that the impacts of the COVID-19 shock worldwide would have to work their way through the economy before we could face a recovery. I didn't understand, I guess, the inherent optimism that people have around the world, nor the incredible ability of central banks to provide more near-term stimulus to the economy by increasing amounts of artificially low interest rates. And we're seeing a situation where I had anticipated that the copper price would be sub $3 when in fact it's above $4. All of that by way of saying I have no earthly idea where the copper price is going to go in the near term. I can tell you that 5 years hence, the copper price will be higher, not because of economic circumstance, but rather because for the last 30 years, the world has underinvested in copper exploration, underinvested in copper development, underinvested in copper mine construction, and because copper mines take decades to finance and to permit. Almost no matter what we do, in almost any set of economic circumstances other than an outright depression, the demand for copper will outweigh the supply for copper, not because demand will increase a lot over the next 5 years, although it might, but because on a global basis, we are living on copper mines that were discovered 40 years ago, financed 30 years ago, built 25 years ago, and are very, very long of tooth. The biggest copper mines in the world, be they Grasberg, be they Escondida, be they Chuquicamata, have been in production 25 years, 40 years, 100 years. The next crop of mines are on the horizon, but assuming that we started now, they wouldn't be impacting copper supply for 10 years. There's a wonderful U.S. copper deposit called Resolution in Arizona, a deep one, a kilometer down, so it's going to be hard to mine. But it's well over 1 billion tons of over 1.5% copper, as against the average mine grade worldwide of 0.5%. Wonderful deposit in copper country, and I don't think this thing will be in production for 10 or 15 years. It seems, among other things, that a jaguar may have been sighted near this copper mine. It seems that part of the copper mine is underneath an area that legitimately has cultural and social significance to the Apache Indians. It's also true that there are many people in Arizona who don't want another copper mine built in Arizona. I'm not going to argue whether any of these things are right or wrong. I'm just going to tell you that one of the most important copper discoveries in the world will not be able to add to supply for at least 10 to 15 years, and maybe never, as a consequence of economics and sociology. And this circumstance is being repeated around the world time and time and time again. There is an inescapable shortage of copper coming on the supply side. So I can tell you with some certainty that the copper price will be higher 5 years from now or 7 years from now. What I can't tell you is whether it'll be $1 higher or $1 lower in the 12 to 18 month time frame, which is, I suspect, the question that your viewer is asking.
Well, we have another one here about silver in specific, or precious metals in general, and it's one that you also think deeply about, things that you probably would have anticipated. I know you've talked to us about people's exit strategy in a rising bull market for any investment. Ivan Gaeta says, over the next few years, all of the new precious metals investors will be slowly divesting the metal that they have acquired under the pretense that prices are getting squeezed. What happens if everyone dumps their metal on the market all at once at old nominal highs and again in triple-digit territory? I understand that a savvy investor will hold on to a certain portion of his stack regardless of the price and dollar value, but there's also a ton of people that don't know what they're doing that are in the space currently, and I'm going to bet that there are millions of ounces that are just waiting for a slight profit before selling, and I'm worried that this could have a cascade effect on hard-won price discovery.
The questioner needs to understand, first of all, that I'm the wrong one to ask that question to. Understanding the impact of a narrative on a market is one of my weakest possible suits. So let's start there. My observation, however, is that the questioner is exactly wrong. My observation of the way people act is that a rising price justifies the narrative, which is to say that more people would sell gold if the price declined from $1,750 to $1,600 than would sell gold if the price went from $1,750 to $2,000. It's important to understand that price action, particularly recent price action, justifies the narrative. If people bought gold because they believe that an increase in the gold price would shelter them from depreciating purchasing power in U.S. dollar terms, and gold did that, which is to say the price went up in U.S. dollar terms from $1,750 to $2,000, people believe that that price action justifies the narrative that caused them to buy gold in the first place. That's why the back end of bull markets in any commodity become J-curves. That's why the last stages of a bull market, the blow-off stages of the bull market, are so completely irrational. And so while I suspect that at some point in time we will have a blow-off rally in precious metals prices, I don't think it will be related at all to prior highs. Ultimately, it will be related to fundamentals, although you'll have a blow-off rally before the fundamentals assert themselves. And the fundamentals are as follows. Quantitative easing. You will know that the reason to own gold and silver is over when quantitative easing is over. When governments stop counterfeiting, I guess I should say if governments stop counterfeiting, then you need to be cautious about your precious metals holding. Debt and deficits. When the increase in the deficit in the United States is less than the rate of economic growth in the United States. In other words, when our economy is expanding vigorously enough and our Congress exerts enough discipline that the growth in the federal debt is less than the rate of growth in the economy, then we need to worry less about owning precious metals, and in particular, real interest rates. Should the real interest rate on the U.S. 10-year Treasury revert to mean, then you need to begin to think about coming out of your gold and silver. What does this mean? The nominal interest rate on the U.S. 10-year Treasury is 175 basis points. The trailing CPI rate of inflation is 160 basis points. If you don't think that inflation is going to pick up in the future, what you do to find the real interest rate is you subtract the CPI rate of inflation from the nominal interest rate. That is to say, you subtract 160 basis points from 175 basis points, and you see that the U.S. 10-year Treasury, by that definition, is 15 basis points positive. The 30-year mean for positive real interest rates, by that metric, is between 150 and 200 basis points. So for the real yield on the U.S. Treasury to revert to mean, the nominal interest rate would have to be 160 basis points plus 150 basis points, which is to say 315 basis points up from 175. If the CPI stated rate of inflation increases, you would have to add whatever that CPI rate of inflation was to the nominal interest rate to calculate the real interest rate. Suffice it to say, if you saw a circumstance where the yield on the U.S. 10-year Treasury was between 150 and 200 basis points real, by that calculation metric, then you need to be concerned that the end of the precious metals bull market is over. It is likely, in fact, that the nominal bull market will continue because the price of gold and silver will justify the narrative, even though the facts have changed.
We have a follow-up question. This also is, I say follow-up, because it's related to the previous question earlier about copper, but this is from a completely different angle. Kevin Kilgore says, Rick, knowing that silver is a byproduct of, for the most part, of other metal mines, do you think that the gains on copper and nickel could be used to actually suppress the price of silver? If so, has this been done in the past or is it happening now? And should we be all looking at copper as a hedge?
I believe that they fulfill very, very different functions. There is a narrative called reflation, which suggests that in an inflationary environment, any commodity is an inflation hedge. An inflation hedge, as an example, because the capital costs associated with putting a new mine in production are higher. An inflation hedge because the finished price of products is higher and therefore the constituent prices can be higher. But I regard copper and nickel and silver as having separate utilities and ultimately being separate markets. One needs to consider copper production because so much silver is a byproduct of copper mining, which is to say if you produce more tons and extract the copper from it, the byproduct silver production ultimately gets added to silver supply. And in fact, the byproduct silver supply from copper mines or copper lead zinc mines is more important than primary silver supply. So in that regard, they're related markets. But otherwise, the similarities between copper and nickel and silver, in a real sense, are different. That doesn't mean that if copper is outperforming silver, that the narrative associated with copper as a way to shield yourself from inflation won't present some challenges for silver markets on the margin. Not that it should, but it might.
So in regards to, based on the economics of copper mining, the questioner was asking, do you think that owning copper mining or participating in copper mining stocks is a way of hedging their bets against physical silver ownership?
I don't. One owns physical silver for monetary reasons. One owns copper for market and utility reasons. They're very, very different markets. It is true that silver has wonderful fabrication uses, solar energy, and germicides, religious iconography, jewelry, all those things. Copper is much more closely associated with the ascent of humankind. When you think about copper, think about 1.2 to 1.3 billion people in the world who have no access to electricity, but want it and will have it in the next 10 years. Think about the urbanization of mankind, people who have access to electricity now, but have increasing incomes and want to live the lifestyle that you and I enjoy. Copper is all about the ascent of man. Silver is partially about the ascent of man, but silver is also partially about a medium of exchange that's simultaneously a store of value. Silver is partially about being a precious metal that's more volatile, both to the upside and downside than gold, a way to speculate, if you will, on lack of faith in the ongoing purchasing power of conventional savings instruments denominated in fiat currencies.
Follow-up question here on silver. Tainted Metal asks, do you think governments will ban or restrict or exorbitantly tax precious metals when going to a digital currency? If so, if the governments go to such efforts to remove them from citizens' hands, is it not sensible to expect them to outlaw their use in trade or barter?
That's something that I would have worried about 40 years ago. What we've learned is that it's much more efficient for the government to steal from you indirectly rather than directly, which is to say, rather than force you to invest your IRA in Treasury securities, which I would have been afraid of 40 years ago, rather than having them confiscate your guns, rather than having them confiscate your gold and silver, what they have learned is that they can steal from you indirectly, and it's extremely popular. Quantitative easing, which is debasing the currency, is theft, and it's extremely popular. Debt and deficits are theft. They're an income transfer from young taxpayers to old beneficiaries like myself. They're publicly condoned theft. Artificially low interest rates is theft. It's a political war promulgated by the spenders who are numerous on the savers who are scarce. All of those are forms of government theft, and all of them are extremely popular. If the government went to steal your precious metals, that would be regarded by the population as a whole as overt theft, which it is. And that would be dangerous for the government to do, particularly with 400 million guns in circulation. But stealing from you by inflation, stealing from you by counterfeiting, stealing from you by debt and deficits, stealing from you by artificially low interest rates is not only more efficient, it's also popular. Why would they steal overtly and run a risk when they can steal covertly and be rewarded?
It's astonishing how many stealth taxes there are. The understated rate of CPI, you mentioned the headline 1.6% or 1.7% recently, and there's others, the indexing of alternative minimum tax, which was supposed to, the story was it was going to only do the 1% or the 0.5% or whatever. Now it's more and more people are applying to it. FICA, same thing. The annual proportion of an earner's wages that are subject to FICA just keeps going up and up and up and up every year. So there's all of these they're on autopilot, cruise control, just keep on carving out bigger and bigger pieces of your life and your livelihood. But nobody's taking direct action. Although I have to say, in the defense of our viewers who may be pointing to things like civil asset forfeiture on the increase and other things, there have been some pretty scandalous and rash overreaches in terms of overt theft by government, in addition to everything that you said that's being done in a cowardly, stealth manner.
I'm certainly not saying to drop your guard. All I'm saying in response to the viewer's question is that while I don't put anything as being beneath them, I learned from reading Human Action that people do what they believe to be in their individual self-interest. And from a congressman's point of view, the idea that he or her would condone direct theft, either from your IRA or from your stacking stash, presents risks to them, while stealing from you by indirect methods only conveys reward.
Well, Rick, we've got more questions than we have time for. You've been generous with your time already, so we're going to have to regroup another time. But we'll put up in the description of this video, folks, is going to link that Rick is going to send me to this panel that's going to happen this Thursday, April 29th, 2021, on Robinhood, Reddit, and the rise of the retail investor, with a cast of very influential characters and analysts in that space for your learning. And also, I wanted to make sure and people go to our website, libertyandfinance.com, get your name in there for our newsletter so that you don't miss out on any of our guests, including Rick, and any of the links that he provides, all the links that all of our guests provide. Also, keep tuned for a Silver All-Star panel this week. We haven't had a large format panel yet on Liberty and Finance, but we're going to have our first. We're going to have David Morgan, Craig Hemke, we're going to have Bill Murphy, the Wall Street Silver Gang, and Andy Schechtman, among others. So don't miss out on that. That'll be coming your way by this Friday at the very latest. So Rick Rule, now of
Rule Media.
Rick Rule of Rule Media, thank you for joining us again on Liberty and Finance.
Donegan, if I might renew my rankings offer.
Please.
Any of your listeners who care what I might think about their natural resource investment portfolio are invited to find out. If you go to sprotusa.com/rankings, that's sprotusa.com/rankings, enter your natural resource stocks on the pull down form. I will rank those stocks 1 through 10, 1 being best, 10 being worst, and comment on individual issues where I think my comments might have value. I enjoy getting into discussions with your listeners, Donegan, and the best way to do that is to begin the discussion with something near and dear to their heart, which is to say their own fortunes, their own portfolios. So thank you for that opportunity, and thank you for the interview.
Very good. Thanks for offering that for our guests. They always take advantage of that, and the backlog is less now because you've got it more streamlined how you get those responses out to people. So thanks for making that change.
A pleasure. Thank you.
Take care.
Thank you.
This is Donegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com.